the entry on December 31. There are actually two entries here. The first one, they say, the company paid provisional tax of 270,000. Provisional tax payment is simply that we are paying tax in advance. We are paying tax in advance. Therefore, provisional tax payment of 270,000. We are paying tax to whom? To SARS. Therefore, the accounts that are affected there is the bank and the SARS account. Therefore, we are going to credit bank with SARS income tax. Why? Because money in the bank decreases and the amount there is 270,000. At the same time, we are going to debit, to complete the double entry, you are going to debit SARS with bank 270,000. You are going to credit SARS with bank 270,000. Credit entry must be accompanied by a corresponding debit entry. 5. The second part of that transaction says, an interim dividends of 20 cents were declared. Interim dividends of 20 cents were declared. Were paid. They say the company paid provisional tax of 270,000 and interim dividends of 20 cents. Now, in order to get the total amount for those dividends, what do you need to do? You need to establish how many shares were in issue at that time. We know that at the beginning of the year, there were 500,000 in issue. At the beginning of the year, there were 500,000 shares in issue. In addition to those, 200,000 shares were issued on 1 July, which means all in all, there are how many shares? 700,000 shares in issue on 31 December. We have 700,000 shares in issue on 31 December. Now, how much did they pay per dividend? They paid 20 cents. Therefore, we are going to multiply by 20 cents per share. Now, the total amount of interim dividends paid would be 700,000 multiplied by 20 cents. 700,000 multiplied by 20 cents. Therefore, interim dividends is 140,000. These are your interim dividends. Now, these were paid, therefore they are going to decrease our bank. We are going to decrease our bank with ordinary share dividends. How much? 140,000. The question did not ask us to prepare ordinary share dividends, but I'm going to open that account just to illustrate ordinary share dividends. We have credited the bank with ordinary share dividends, therefore we must debit ordinary share dividends with bank 140,000. Right. Then we go to our next transaction. They say at the end of the accounting period, the company made a second provisional tax payment of 250,000. Now we are going to record this transaction in the same way as we recorded that one, because these are both provisional tax payment, which means we are going to do what? We are going to credit the bank account with SARS income tax, but this time around we paid 250,000. 250,000. and debit SARS with bank 250,000. Okay, fine. Then on the 30th, of June, the directors decided to buy 60,000 shares from a shareholder per share. A check was issued to him. Now, this is 7 rand. We call it the purchase price. The purchase price. This is the price that we pay to purchase the shares from the shareholder. Okay? Right. We paid 7 rand. Now, let me briefly outline the steps that we need to follow when recording the buyback of shares. The first step is that we need to calculate the average share price. We need to calculate the average share price. Now, how do we calculate the average share price? The average share price is the rand value of the shares issued to date, up to the date of purchase, divided by the number of shares issued to date, which means the value of shares over number of shares issued. Right. Now, what is the value of shares? We can simply get those from our ordinary share capital account. Ordinary share capital at the beginning, we had 2,500,000 rands, plus we issued a further shares for the value of 1,280,000. Therefore, it means now is 3,780,000. Now, we know the value of the shares that were issued to date is 3,780,000. And what did I get this information? I got it from my ordinary share capital account. This I must divide by the number of shares that have been issued to date. What is the number of those shares? Is the 500,000 plus the 200,000 that we talked about earlier. That gives us 700,000 shares. Now, which means our average share price will be 3,780,000 divided by 700,000 shares. 3,780,000 divided by 700,000 shares. The average share price is 5 rand 40. We said that is the first step. You calculate the average share price. The second step, you reduce the ordinary share capital account. When you reduce the ordinary share capital, it means you must debit it, because the share capital account has a credit balance. If you reduce it, you must make an entry on the opposite side of the account. You reduce it by the number of shares, by the average share price, multiply by the number of shares being repurchased. Now, what is our average share price? We know, we have just calculated it. It is 5 rand 40. How many shares are being repurchased? We said we are repurchasing. How many shares are being repurchased? We are repurchasing 60,000 shares. Therefore, 5 rand 40 multiplied by 60,000. 5 rand 40 multiplied by 60,000 give us 324 324,000, which means you are going to reduce ordinary share capital by 324,000. Therefore, you go to your ordinary share capital, you say bank 324,000. That is the income. When we issued shares, we credited because our share capital increased. When we buy back the shares, we debit because the share capital decreases. And the last step of the buyback of shares is that you reduce the retained income by the difference between purchase price and average share price. Now, you know the difference is when you subtract. Therefore, what is our purchase price? I have said the price that we pay to the shareholder, here is our purchase price, is the price that we pay to the shareholder. Therefore, that will be 7 rand. That will be 7 rand. We subtract the average share price, which is 5 rand 40. Therefore, the difference will be 7 rand minus 5 rand 40 would be 1 rand 60. Are you okay? Fine. Reduce the retained income account by the difference between the purchase price and the average share price. We have calculated the difference and we found it to be 1 rand 60. And then we say we multiplied 1 rand 60, that difference, 1 rand 60, you multiply it by the number of shares being repurchased. Now you say 160 multiply by 60,000 shares. Multiply by 60,000 shares, it gives us 96,000. There you go, 96,000. Right, then you go to retained income. Remember the retained income, our retained income has a credit balance. If you want to reduce it, we must make a debit entry. Then you'll say bank. And what is the amount that we have just calculated? 96,000 rand. 96,000. I'm not going to do the alternative method, otherwise I'm going to confuse you. Right.